Hello, and welcome to the buyer's consultation for those first time, long time, and just need to be double checked buyers. I'm your host and your local neighborhood realtor, Raytonya Hughes, with the Excellentway group of Keller Williams, Tuscaloosa, and we're going to dig into what it takes to get you ready to purchase a home from start to finish. So, welcome to the home buying process. In today's presentation, we'll go over the necessary information to get you prepared to purchase the home. This is not necessarily what you're going to do when you're actually shopping. We'll actually go over that in a different video, but this is for those people who say, I want to know what I need to do to get started. I want to know what things are going to be required of me if I want to start purchasing a home today, tomorrow, even 6 months or 6 years from now. The first thing that you're going to need if you're actually getting this home funded with a finance company like a mortgage lender, a credit union, or a bank, is you're going to need documentation. You'll need the two most recent bank statements. You'll need your two most recent pay stubs. And this is for any income that you intend on using. So if you have a part-time job, but you're not going to include that income, you wouldn't put those pay stubs in. If you have a primary job and two or three part-time and you want all of that income, we're going to need the pay stubs the last 2 months for all of that income. You'll also need your two most recent years W-2s. So if you are, for example, looking to purchase a home and it's the end of any particular calendar year, you're going to use the last 2 years. You hadn't yet filed income taxes for the current year you're in. So you'll use the last two calendar years to actually get W-2s. Now, if you end up looking to purchase a home and you're applying for a financing at the beginning of the year, then you may be asked later on in the process to go back and pull the taxes and W-2s or give the W-2s from the last calendar year. So just know that it's the last 2 calendar years, depending on where you are in the current year, it may determine if they're going to ask you for the most recent ones. You'll also need your driver's license or some form of proof of ID and your social security number. This is for any and everybody that's going to be attached to this loan. So if you have two or three people, maybe siblings or partners in business, this is for everybody. And I want to note that this is for your traditional residential purchase of a property or land. We are not going into financing for investor properties. This is just primary purchase of properties right now. If you are going to actually purchase your home with a cash purchase, you will need to have a letter from your financial institution showing proof of funds in the account that you're going to use to purchase the property. You would simply go to your local finance institution and just say, hey, I'm purchasing a home for X amount of dollars. Can you write a letter stating that I have that amount of funds in my bank? They'll write the letter out on official letterhead, and it just will say, to whom it may concern, John Doe has funding in the amount of XYZ to cover the purchase price. You won't tell them exactly how much is in your bank. You're just saying that you have the amount of money that you are purchasing the home for. If you have other income like child support, Social Security, disability, retirement, or 401k, or things of that nature, you'll also need to have documentation of that if you are going to use it to purchase your home. So, for example, if you have child support, you would need not only to show that you're receiving it on a monthly basis, but you would also need that child support order. I highly recommend that if you are using any of this documentation, that you reach out to the lender that you're going to speak with to let them know. There may be certain criteria depending on each one as to how long you have to have it, how that needs to be documented. So when you're doing those things, make sure you say upfront, hey, I'm going to use Social Security disability, and they can ask you how long have you had it, because in some cases, if it has not been a long enough amount of documented time that you've been receiving it, it may or may not be allowed to use in the calculation of your income. Self-employed. If you are self-employed and you intend to use your self-employed income, even if this is in addition to a W-2, W-9 employee, you'll need 2 years federal taxes, a balance sheet showing your assets, a profit and loss statement, and anywhere from 2 to 6 months bank statement to just show that you are indeed eligible to purchase this property and can afford it. If you have variable income like overtime, travel nursing, housing allowances, rotating schedules, commissions. This is very much like the other income that we talked about. You'll want to go up front and let your lender know that you'll be using this. Some of this can be used, some of it cannot. Some of it has to be used in a certain time frame. So in order to make sure that you are properly documenting this, you'll want to go ahead and let your lender know upfront. Like, go ahead and make the application, but maybe have a phone call beforehand and say, hey, I'm about to submit an application. This is what my situation looks like. How do I need to document this? And when you have these things, they will give you specific documentation that needs to be done. I would like to note with travel nurses, oftentimes one of the things that they're going to ask for is record of the contracts that you signed. So if you have previously been on travel assignments, I recommend going ahead and getting the documentation of those, not only the pay stubs that you receive your income, but getting the contracts together and the names and addresses and contact information of those actual assignees of those contracts that you work with. All right, now trade lines. This is something that a lot of people don't think a lot of it, or they don't understand what it is. Trade lines are lines of credit, for example, car payments, credit cards, furniture bills. It can even be things like your car insurance. It can be your things like phone bills, and it can even be gym memberships. And I'm going to put in here even things like Hulu and Netflix could absolutely be included. What happens is real lenders want to show that you have evidence of at least three trade lines. So I always ask, do you have a car note? Do you have maybe a furniture bill? Maybe you have a small personal loan with your local bank or local finance company. Do you have maybe your AT&T bill? They want to show and see where you've been paying something on time every month for about 12 months. If you don't have this, they may come in, and they being the lenders, and ask you to get some of this established before they extend a finance loan for your home. So once again, these are conversations to have with your lender upfront, even before applying. They may say, yes, I hear your situation, I hear your circumstance. Let's go ahead and apply, and then we'll look at the whole situation. But these are things that you need to know that they are looking for. So what else are the lenders looking for? They're looking for your debt to income ratio, your credit utilization. They're looking at collections, on time versus late payments, student loans, bankruptcy, and credit score. Now, most people know about credit score, but let's dig in a little deeper to these other things. Debt to income ratio is the amount of debt versus the amount of income that you bring in. So, say for example, your monthly income is $5,000, but you have $5,000, but you have $2,500 in monthly debt. Let's not have $25,000 in debt, and you're only generating $5,000 in income. That would have your DTI at 50%. Now, when we're talking about monthly debts, we're talking about those things that we previously spoke of, like trade lines. So, if you have a car note of $500, if you have $1,000 worth of furniture bills, if you have an additional $1,000 worth of small loans and credit card payments, that would be that $2,500. It's not the amount you owe, it's the amount that you're paying every single month. And I also want to let you know that something that is often included that people don't realize are Afterpays, Klarna, PayPal, any of those monthly payments or bi-weekly payments that are out there, they will calculate those. So if some of those are things that you can kind of get taken care of before you actually apply for a loan, go ahead and get it done, because they do consider that as part of your debt to income ratio. It is a bill that you're paying every single month or every single 2 weeks or something of that nature. If your debt to income ratio is greater than 30%, then the amount of home that you can actually purchase starts to decrease, because lenders look at it and say, hey, she's spending or he's spending a lot of their money on monthly debt. There's not a lot of room for them to purchase a home and spend monthly payments on home. So be mindful of that. Credit utilization is very similar to debt to income ratio. However, it is based on a particular line of credit. So, for example, if you have a credit card bill and the balance is $3,000, or the amount your credit line is $3,000, and you've actually spent $2,000 of it, your credit utilization is at 67%. So you may hear a lender say, hey, we think you're good, but we need you to pay down this credit card. That's what they're looking at. So the higher your utilization, then the lower the amount of money that can extend to you. Because what it appears to them is you're overextended. So you want to show that, hey, I have debt, I'm managing my debt, and I'm not overextended. Collections. Collections are any outstanding accounts that have been moved to a collection agency. I highly recommend before going in and just wiping away all of your collections, once again, speak to a lender. If you've got money set aside to take care of these things, speak to a lender first. They may tell you, we don't want you spending money on collections. We want you spending money on your DTI, or we want you spending money on your credit utilization. Let your lender determine what you need to do. Oftentimes I hear people say, well, I went to a credit repair person. I have no issue with you going to a credit repair person, but the thing about it is, credit repair people don't get you in homes. Realtors don't get you in homes. We don't extend the lines of credit that allows you to get a mortgage loan. So who does that? Your mortgage lender. So who do you need to reach out to about what is the exact scenario for you and how you need to spend your money to get into a home loan? It's your home lender. So talk to them about that. uh, on time versus late payments. This is the number one thing that can affect your credit. It literally 35% of your credit score is based on payment history. So if you don't do anything else, make sure you're paying all accounts on time every month. If you're required to make the $25 balance, that's the minimum payment. At the very minimum, pay the $25 on time. You may pay the $25 on time to ensure that you're paying your bills on time and then later go back and pay an additional amount, but make sure you're paying your bills on time every month. This is one thing that can really hurt your credit score if you are 30 days late. A lot of times people ask, well, what is late? So say your bill is due on the 1st and you pay it on the 5th or the 16th, then they've charged you a late fee. That's one type of late. Hitting your credit report is it's due on the 1st and you don't pay it until after the 30th or on the 1st of the next. It is now 30 days past due. It is now eligible to be reported to the credit bureau, and most agencies will actually report at that point. Student loans. Any student loans will have to have a positive payment history and a letter stating the loan is, or the letter is stating that it's in forbearance or deferment. A letter of payment amount will need to be provided. So I highly recommend, if you're planning on purchasing a home, go right ahead, find out who is holding your loan for your student loan and getting some information about it. Because one of the things that kind of can hold up a loan is getting this documentation. You may find out really like, oh, we'll get that information to you in about 30 days. So we're not going to do this once we're ready. We're going to get this information before we're ready. Bankruptcy. If you have a current or past bankruptcy, your requirements will vary from lending institution. This will need to be addressed immediately, meaning before the application, to ensure that you're partnered with the appropriate lender. Some lenders don't do bankruptcies. Some lenders do. Some lenders do, and they have different requirements. So one of the things that you're going to want to if you reach out to your realtor first, then just say, hey, don't be afraid. We're all on your team here. Let me know up front. Hey, Ray, currently in bankruptcy. This will help me partner you with the right lender. Or, hey, Ray, I've recently gotten discharged from bankruptcy. These will determine which lending partners are going to best work with you and for you. Your credit score. So, one of the things that people want to know up front, what does my credit score have to be? That's almost the number one question that I get from everybody. I get on the phone with them and I start talking and they say, hey, what's my credit score have to be? Or my credit score is this, or my credit score is that. And I usually hear it from both ends. I either hear, I don't know if I can buy a house. My credit score is five something, or I know I can get a house because my credit score is 720. Well, as we've seen in the previous slides, having a 720 credit score does not automatically qualify you for getting the house of your dreams. It may qualify you, but if you have other things going on, like maybe your debt to income ratio is a little higher, you once had an 850 and you're at a 720 because your DTI is high. So we need that DTI to come down. You may have a 720 credit score and everything looks beautiful, but you have limited income. You may qualify for a home, but you wouldn't qualify for two, three, 400, $500,000. You would qualify for more like 100, 150, maybe even less than 100. So all of this is a portion of what gets you qualified. But lenders typically require a credit score minimum of 620 to 660 to purchase a home. As of June 2022, FHA loans can be obtained with a 500 to a 580. A down payment would be required, but it just varies. So if you have a 500 to a 579 and you're going to get a FHA loan, typically nothing is set in stone, and these numbers can change from day to day, week to week. You're going to put 10% down. If it's a 580 or higher, you're going to put 3.5% down. So you could have an FHA loan and you could have a 750 credit score, an 850 credit score. You're still with an FHA loan going to put 3.5% down towards the purchase of the house. So if the house that you're purchasing is $200,000, 3.5% is $7,000 that's going to come out of your pocket. VA loans are typically a minimum of 580. Can't really see that because you see my face, so just take note. If you are a veteran, 580. So, what are they doing to calculate it? You typically have three credit scores. Now, sometimes I've seen people who do not have all three major credit bureaus with a credit score. That's because only certain companies report to certain bureaus. So, if you have limited accounts and the accounts that you use don't report to all three bureaus, you may not have a credit score with all three. So, that's why I say typically. But they use the middle score to determine an applicant's credit threshold. So they'll pull all three credit scores from all three major bureaus, and whichever bureau has the middle score, not the highest score, not the lowest score, that's the score that they'll determine. So if they pulled one credit bureau at 650, the second one 630, the third one 690, then 650 is what they're going to use. And based on the last slide that we looked at, or the last couple of slides, 650 should be able to get you in a loan, not necessarily every lending institution, but you should be able to find a lending institution that can assist you. Now, if more than one person is going to be on there, so let's just say it's two people, it's a husband and wife, and both individuals are applying, the lender will use the lowest of the two middle scores. So they'll find the middle score of spouse one, like we said last time on the last slide, and then they'll use middle score two for applicant two, like we did on the last time, and whichever one of those has the lowest score, that's the score that they're going to use for the credit threshold. I get this question all the time. Can I use someone's income without a person's credit score? Typically, I love to say the word typically because there's always odd things that may pop up in different lending programs. But typically, lenders will not allow the income of one person to be used without the credit score of another. Now, there are some exceptions to this. So, say, for example, you have a child in your home that's receiving disability. That child is not going to be on this loan. However, that is a part of your income. So, you would be able to use that income, especially if that child is going to be receiving that income for an extended amount of time. Or it doesn't have to be a child, it could be another individual in the home. Your credit score not only helps you get the approval, it also determines your interest rates. The lower your score, the higher your interest rates. The higher your score, the lower your interest rates. And so what we kind of mean by that is things like, we're not talking about the difference between 7% and 25%. We're talking about things like 7 to 7.5 to 8. In a smaller margin is what we're looking at. So once you actually get the loan approval, there are four different major types of loans: an FHA, a VA, a USDA, and a conventional. FHA, VA, and USDA are all federally backed loans. And so the restrictions or the qualifications tend to be a little bit more firm. And then there's conventional. Those are typically done in just about any bank or lending institution. And oftentimes they are serviced in-house with that particular bank. VA and USDA are always 100% financing. FHA is somewhere between 3 to 3.5%. I said previously that there is at FHA is always 3.5%. I want to correct and say there are some lending institutions that have certain programs where they kind of help you with that 0.5%, so it can be 3%. And conventional can be anywhere from 0 to 20% to whatever your heart's desire. There are some lending institutions that offer zero money down conventional loans. But on just an average basis, if they're requiring a down payment, it's about 3%. That whole myth of it takes 20% down payment to purchase a house is not true. But can you put 20% down? Yes. What they're usually speaking of is that when you have paid at least 20% into your home loan, then you decrease PMI, which is private mortgage insurance. I won't go into details with that today, but you can see other videos that will discuss what that is. So you've gotten your approval. Let's go shopping. Let's go shopping. So how do you shop? Once you've gotten approved by a loan, or let's go back to slide number 2 that says cash. You have either an approval letter, a fee sheet that talks about PITI going down in a few minutes in HOA, or you have a proof of funds letter. One of these two things is what you have in your hand to begin the shopping process. So for those of you that hung in here long enough to talk about cash buyers, this is where we pick up for you. If you were actually got funded through a finance institution, this is where we start the shopping process. Your approval letter will have your loan amount, the type of loan, the expiration date, the lender information. A lot of times I'll hear people and they go, I got my loan amount, and that's all they care about. But there's a few other things that we want to focus on in addition to that. But I'd also like to speak to our cash buyers. Yes, you may have the flat out fees to actually purchase the house, but I want you to consider other things as well that may come along with the purchase of the house. And these things are included with you as we go along going forward. Your fee sheet talks about the breakdown of the loan, the percentage rate, the down payment amount, buy down points, expected homeowners association insurance taxes, and your monthly payment. If you are a cash buyer, you still need to know the purchase price of the home. You need to know what the homeowners association fees, if there are any, what the annual taxes and the annual insurance will be. Because if you're paying for this house cash, then all of these other things will also need to be paid for in advance, or you need to have it in budget that you're paying for this monthly. There are also out-of-pocket fees. This is for anybody, even if you're one of those buyers that have said, I have a 100% financing like a USDA or a VA, or if you're a cash buyer, everybody will still have these out-of-pocket fees. There's a couple that you wouldn't have to consider if you're a cash buyer, and that's down payment, but I'll speak to that in a few seconds. So, what are the out-of-pocket fees? Number one, earnest money. Earnest money is a deposit to the seller that represents a buyer's good faith to buy a home. The money gives the buyer extra time to get financing and conduct the title search, property appraisal, and inspections before closing. In many ways, the earnest money can be considered a deposit on home, an escrow deposit, or good faith money. So this is where you say, hey, sir, or hey, madam, I know you're taking your home off the market for a period of days, and I, with the intent that I'm going to purchase it from you. This is the money that says, I mean business. I intend to actually purchase this home. I'm just going to take some time to get these things done. Earnest money is typically anywhere from $500 to up to 2% of the purchase price. The more money that is actually negotiated, because everything in a contract is negotiated, is typically the more the house costs. And when you start looking at percentages of a house, that's typically a home where you are getting it built from the ground up. Before a construction builder wants to start the process, they want to kind of make sure you have some skin in the game. Once again, this is part of a contract, and so all of these numbers can be negotiated. I want to go back to this for a second and say with that for before I go any further, with earnest money, I recommend you have about $1,000 set to the side. So home inspection. Home inspection is a general inspection of the home that includes all parts, but a specific focus on the major systems, which is roof and the framing, foundation, HVAC, electrical, and plumbing. They're typically anywhere from $450 to $600. It's based on square footage. I've actually seen home inspections up to $2,500. That was a home that was 3 stories and 6,000 plus square feet. So I tell most of my everyday general homes between 150, $100,000 up to about $300,000 that you need to set aside about $500. When you do the home inspection, I do want to say, and we'll do more videos about this later, that when you're doing this, you're not trying to make sure the home is in perfect condition. You're trying to make sure that the home is in livable condition. There's no health and safety issues. And once again, that there's nothing going on with the major systems. We live in a as is or buyer beware state in Alabama. If you're looking at this and you're not in Alabama, things may be differently in your particular state. And so you can always message me. We can talk about this. But in Alabama, it is a buyer beware state, which means the burden of proof to figure out if things are wrong or right in the property relies only on the buyer, not the buyer's agent, not the seller's agent, nor the seller. So just keep that in mind. Having a home inspection is vital. There's also a wood infestation report. It's an inspection of the home to determine if there is any past or present termite, beetle, and or fungus infestation. They're typically about $150 for the inspection and $150 to establish the termite bond. Then after you actually get in the home, you would be responsible for paying either monthly or quarterly payments to continue to treat the home, depending on who your termite provider is. This is something that you don't necessarily have to do, but once again, it's highly recommended that you get these things done because the last thing you want is to actually go in a home and there's termite damage. And it may be mediocre or very small at the time, but gone unchecked and untreated, you could have some major damage to your home. The appraisal. This is ordered by the lender to determine the value of the property. It's typically around $600. This is not something that is ordered by you. It is not something that is ordered by your realtor. This is ordered by your lender. If you are a cash buyer, this is something that you can or cannot do. You don't have to do it, but I recommend, once again, knowing the value of the property. So when you have a home inspection, it's going to tell you the quality of the property. An appraiser is going to tell you the value and the quality of the property. So, for example, an appraiser would come in and say, you look at the property and you've offered maybe $250,000 for the property. An appraiser is going to come in and go and look and say, yep, this house is worth $250,000. They may say it is worth $250,000. However, there's some issues that need to be taken care of before we can sign off on this appraisal. That would be where you negotiate with the seller to have those things done. Or the appraiser may say, this house is not worth 250, it is only worth 195. Now, what would happen in some of these situations, if it appraises for value, you just keep moving forward. If it appraises with conditions, then like I said a few minutes ago, you would negotiate with the seller to get those things taken care of. If the house does not appraise for the amount that you've negotiated on the contract, you have a couple of options here. You'll either go back to the seller and negotiate for the lower price. You can pay for it out of pocket, the difference between the negotiated price and what it appraised for. So if you offered 250, it only appraised for 195, you would pay out of pocket $55,000. Or if you can't come to an agreement or you don't have the additional funding, if you are actually financing this deal and you've written it in the contract, if it's written in the contract that it is contingent upon appraisal and it doesn't appraise, you can get out of the contract because that's part of the contract. So there's some options. Now, if the house appraises for above what you did, so you offered 250, appraiser comes in and says this house is worth 275, the seller cannot make you pay them 275 and you walk into the listing, or excuse me, you walk into the property with some equity. So that's an awesome one. Septic tank inspection. This will not necessarily be for every client, but sometimes it is a situation. If there's a septic tank on the property, once again, I highly recommend you have that tank inspected. You want to make sure that it's working properly, it's not cracked, it's sealed, it's pumping, it's doing everything that it's supposed to do. And so you'd want to have about $400 set aside for that if you decide to get a property that is going to have a septic tank. If it is in rural and outskirt areas, that is a high probability that that will be the case. But that's not to say that there are never septic tanks within city limits. There are other inspections and services that a property may require, and specific to the property, and they'll be assessed on a case by case basis. You're going to at least be looking at about $200 or more. Say you want a survey for your property, those can run upwards $1,200 depending on how big the property is that they're surveying. So just know these are some things that may come up, and as you purchase your home and you're going under contract and we're looking at things like that, I will discuss with you if there's a need, or if we get through the inspection and the inspector says, hey, I recommend you have additional inspections done. We can talk about those things then. Down payment. This is the out-of-pocket funding needed to cover the full cost of the loan. So we talked about this if you have some type of financing situation. So if once again, if you had a $200,000 loan or $200,000 house, you have an FHA loan where they require 3.5% down, that's $7,000. With down payments, most of the time, you are not allowed to get this as anything paid by the seller. It's going to be something that's paid by you. They may allow gift funds, they may not allow gift funds, but it's typically your own funding, or it is something where you have down payment assistance. The lender will talk to you more about that if that's needed. If this is a cash deal, you wouldn't need a down payment. And then closing costs. Closing costs are the expenses over and above the property's price the buyers and sellers usually incur to complete a real estate transaction. Those costs may include loan origination fees, discount points, appraisal fees, title searches, title insurance, surveys, taxes, deed recording fees, and credit report charges. These are something that can be paid by the seller, by the buyer, and a combination of both. There are closing cost fees for both sides, but you as the buyer, if you need those paid for on behalf of the seller to pay for it on your behalf, then those can be negotiated in contracts. They are typically 3%. So if you had a $200,000 home, closing costs you can estimate would be about $6,000 with a just traditional loan. Closing cost fees are a little bit more when you have a VA loan or a USDA loan. If you are a cash buyer, you will still have closing cost fees. If you have any questions about what we've talked about today or what I've presented today, please don't hesitate to reach out to me. You can always reach me by text 205-526-6155, or you can email me at raytanyahughes@kw.com. I want to help you get in a home. It doesn't have to be tomorrow that you're looking to do this. It can be several months from now. It can be several years from now. But I believe that it's best to be prepared now versus prepared when you think you're ready, because it may take a little longer to get things in order. And you're kind of like, oh my gosh, I see the house that I want. So don't wait until you see the house that you want. Give me a call today. Let's get you on a path. Let's get you partnered with the lender. So when you are ready, you are ready. I hope this information finds you more informed about the process and eases any anxiety or fear that you may have. This is just a quick overview, but if you have more questions, like I said, give me a call, shoot me a text, send me an email, and I'll be happy to answer any and other questions that I have or point you in the direction of someone who may have that better answer for you. Remember, have a great day and an excellent way.